Welcome, everyone. Good afternoon. Sunday, March 12th. Something happened this past week. A couple weeks ago, things looked really good for the Bulls, and shows you what a week's different can make. So here we are. Very timely room. We've got a tremendous lineup of participants for today. Before we get into it, and I'll dispense with too many of my comments, as is our custom, this date in history. I'll go through these quickly. March 12th, 1933, FDR gave his first fireside chat during the Great Depression. That was 8 days after his inauguration. In 1938, Germany annexed Austria. That was in 1938. And then finally, these aren't any order of importance. I just picked them out at random, try to mix it up. March 12th, 1948, James Taylor was born. So there you have it. Anyway, to the matter at hand. Um, since Wednesday of this past week with Silicon Valley Bank's news, the world's been turned upside down. So a lot of questions, a lot of spaces, a lot of conversation about what does this actually mean. Um, prior few months, there's been a tug of war between the Bulls and the Bears. Market been stuck in a trading range. Bulls believing, there's no landing, inflation's not a problem, rates will continue to come down, Fed will ease, liquidity will resume, and back off to the races. The Bears, on the other hand, inflation being sticky, rates not coming down at a slower rate for a variety of reasons, cost of capital continuing to normalize, and what that normalization of cost of capital would mean for all asset classes. So I guess when you see, everyone's got opinions about what's happened, and hopefully together we can try to gain some clarity on what this all means. Kayfabe, I think, is going to Kayfabe's going to speak first, and we've also got Tom Thornton, Dave Nicoski, Michael Kantrowitz. But is this going to cause a financial crisis or not, or is it just a one-off, or could it manifest itself into an economic crisis? What will the Fed do? Will the Fed cut? It seems to me the Fed's kind of stuck. They can't really cut, can't really raise. Will this cause contagion? What does it mean for the financial system? What does it mean for the economy? What does it mean for companies whose business models depended on an incredibly low cost of capital? Some have said, and it surely looks like that, whereas in 2008, you had Lehman and AIG, those are linchpins of what brought everything down. Is this the Lehman moment for technology? So a lot of questions. I mean, imagine you're the Fed. On Thursday there was 300,000 plus jobs announced, and then to be followed in short order by the second biggest bank failure ever. So, does this change anything, or is this just an idiosyncratic issue? I mean, rates fell precipitously on Friday. I don't know. The market may be anticipating the Fed's going to have to do something on the rates front. Who knows? But I just wanted to set the table with the questions, and I'm sure we're going to have a lot of interesting discussion around this. So let's kick it off by going to Kayfabe first. Kayfabe, welcome. Good to see you, my friend. What's up?
Hey, George. Thanks. It's hard to believe you've been nice enough to have me on your dais for almost 15 months now. And the reason why I started this ridiculous account named after Ric Flair and professional wrestling concept of kayfabe a little before that was I thought I could. Well, first of all, I saw some major storm clouds on the horizon, and I thought that my analytical process could, add something to kind of the broader public conversation, and my arrogant part of it is maybe help some people. And over that 15 months since I've been doing these, I've been trying to focus primarily on the cycle time frame, because all of these questions that you asked are hugely important. But it's very easy. I call it the fog of cycles. Navigating cycles are so difficult already because of what's real and what's fake. That's what kayfabe's all about, right? That's what professional wrestling is all about, confusing people into not really, they think it's real, it's kind of fake, it's all these things simultaneously. And so I've tried to focus on the cycle time frame primarily. Not that, trading bear market rallies or speculating, all these risk management, all these things are hugely important. But I think that the cycle is so misunderstood and lacks in focus a lot of the time, because we all get caught up in the day to day. So I thought I'd start there, because what better time than when there's an acute potential crisis, people talking about bank failures and everything else, try to put this all in a cyclical context so that we don't miss the forest for the trees, right? So what I'm going to share now is not analysis. It's my view of what's objective, right? So objectively, we had a 13-year expansion that was really only interrupted by what I call kind of a fake recession, meaning that we didn't get the normal Schumpeter's destruction in 2020 because of all the government support. So you didn't get bankruptcies, you didn't get, kind of the normal stuff that happens. So that's a very long expansion. And that builds up all kinds of issues in market economies, particularly those that are credit-based with a fractional reserve banking system, right? So those are all, I think everyone could agree, a matter of fact. The economy started to slow in 2021, right? Late 2021, the rate of growth started to decelerate, and we've had this inflation crisis. Again, I don't want to get bogged down into the specifics on the who's and the whys, right? There's room for debate on that, but it happened. And since really Q1 into Q2 of last year, long leading indicators, reliable ones, and you had Lakshman Achathan from Ecrion back in August on your space that I participated in, started turning down in a recessionary fashion. When I say long leading, they forecast 9 to 12 months out historically. And they started turning down in a recessionary fashion about this time last year, and they have not turned back up yet. Okay, so again, those are objective. And people argue about, it's different this time with yield curves. Do leading indicators matter anymore? Again, you can speculate on all that you want, but the fact is that they've gone down in a recessionary fashion, and they haven't turned back up yet. Now, I will address one thing. There's a lot of confusion. People see certain things from ECRI and they don't understand what the weekly leading index is and how it fits in their broader framework. So again, I'm not going to get bogged down into that, but just take my word for it that the law of leading indicators, as of Lakshman's last public appearance in, I think it was in late February, hadn't turned back up yet. So that's where we're at. That's all independent of what's going on with the Fed, what's going on. And by the way, those long leading indicators turned down before the Fed started tightening, right? So this was all in the pipeline before interest rates started going up significantly. Okay, so I think that's a hugely important aspect. And for example, ECRI's forecast had nothing to do with Fed tightening at the time. Okay, so that's all, in my view, objective. That was heading into this period. Now, the fog of cycles aspect comes into people don't understand what a recession is. When I say people, a lot of people, obviously there are some, but people get bogged down in 2 consecutive quarters of negative GDP. So some people thought we had a recession in the first half of last year. People think that, the service sector has to contract in a recession, or that the consumer has to weaken first. I mean, there's all kinds of, crazy, I call it kind of flat earthing alchemy. There's all kinds of not efficacious ways of viewing the business cycle. So the business cycle is an organic aspect of a market-based economy. And it's when you get a contraction, when you get recession, it is when you get a feedback loop between sales, income, production, and employment. How those act and intertwine with each other are variable, they're inconsistent, they've been different in past cycles, they're always different. Sometimes certain parts of the economy lead. Sometimes it's coming out of a high nominal, high inflation environment. Other times it's not. So one of the issues that we've had in this cycle, I think, is because the last two major recessions that we had, again, exclusive of 2020, because it was such a weird one, had nothing to do with high nominal, high inflation, right? Most of the experiences that come with those kind of environments are before the vast majority of people's experience. Even George, right? I think you came into the business, what, in 81 or something? So right, kind of commensurate with the last period of any kind of high inflation. So a lot of what people are experiencing right now, they get confirmation bias and recency bias because of what's happened in the most recent cycles. So a lot of that, again, germane to what's happening this week, people are obviously flying off the handle right away that this is going to be like '08 and that, bank failures and all these other issues. And I'm not saying this isn't a serious thing. It obviously is, but it's only natural that, as I call it, the fog of cycles, that people are going to go back to what their reference point is, and that's 2008 for this kind of thing. I put out a piece yesterday, I'm sorry, I guess it was Friday, going a little bit back with the history of the S&L crisis, which actually has, I would argue, more parallels. And that's the other thing, people love analogies and they're important, they help, but because these cycles are always different, you can pull snippets out of all kinds of historical periods. They're never the same. They echo, as we've talked about on these spaces before, George. So I just wanted to start with where we're kind of at. And the economy has been decelerating, right? It's noisy. But if you look at the cyclical parts of the economy, the parts that are the most volatile and that historically most frequently lead the economy into the recession. Again, it's probabilistic. It's not to say you can't have a recession without this happening. That's what made '07 and '08 kind of different, is because that was so centric in financial and mortgage-related areas. Those are already contracting and have been. Industrial production, even if you look at the jobs numbers last week, and again, I always take the government data the first few times around with a grain of salt, because they're subject to revisions. But the areas that were weak were in manufacturing, were in kind of the cyclical parts of the economy. So the business cycle's unfolding kind of normal the way it would, given historical proxies for high nominal deceleration like 73, 74, 80 to 82. So we're on track, and within all this context, what this does, this current crisis, is it introduces an accelerator, meaning that a shock to the system or potential shocks to the system, right? So I'll wrap up with this, is that, I've written about this recently, is as late as the first and second week of September of '08, people were still denying that we were in recession, that we'd still have a soft landing. And that was in the midst of Fannie and Freddie going into receivership. Right. It wasn't until Lehman Brothers hit that it was undeniable. Bullard was out even after. I think it was the minutes came out subsequently from the Sunday or Monday of the Lehman collapse, talking about how resilient the U.S. economy was in the minutes of the Fed meeting, and that we would still avoid recession. Right. So history's easy retrospectively, but when you live through it, and this is why, again, I talk about the fog of cycles. What we're going through and have been going through is very normal, and that even within the context of a recession, and that through all of this lens, what I see this news of the past week is a potential accelerant. Again, I'm not saying it is. SocGen happened. Bear Stearns happened, and they were kind of accelerators short term, but they weren't the Lehman moment, so to speak. I have no idea if this is going to cause an acceleration in the short term. But the risks are there, like the systemic setup remains there. And when you enter these windows of vulnerability, that's when these things happen. So I think from a risk management perspective, that's how people should view this, which is what if it does happen, let's say the normal odds are 0.001% and it's now 15%. Right, and that's why most of these risk models that people consume in dynamic I call them disequilibrium models from that economists use, that they don't actually model reality. So if this is a 15% probability of a dislocation, that's still not likely, but oh God, the people sure as hell aren't pricing that in because their models don't work that way. So I'll stop now and appreciate the platform.
That's terrific, Kayfabe. Please stay there. I'm sure we're going to get into interesting dialogue. To continue that, I'd like to go to Michael Kantrowitz, and then after Michael, we'll go to Tom Thornton. So, Michael, good to see you. The floor is yours.
Hey guys, actually, a quick question before I just give my comments on to Kayfabe. I guess it sounds like you subscribe to Ecri's work.
Just real quick, I do not. I used
Oh, you
to.
don't? Okay.
I know enough now to be dangerous. I've been consuming their research for over 20 years. So as just a little guy, I don't run money anymore. I don't have to move large amounts of capital anymore. So by the time they come out publicly, I can pretty much backfill what they're talking about because I understand their process at a high level. So yeah, I consume what they say publicly and kind of figure it out from there.
So do you know what's in their long leading indicators?
Yeah, I have an idea. I mean, they're everything from profit cycles. They're big into levels and rates of change.
Yep.
So it's as much about the process as it is about the composition. So having these long leading indicators that turn first, and it's both level and rate of change, and then followed by something like the weekly leading index, which is more like maybe 2 quarters out, followed by the short leading, and then obviously coincident. But like for example, back in the late '80s, I think it was Jeffrey Moore with
Yep.
what was it? The JOC at the time came out with the index on non-traded industrial commodities, for example. Right. So that's the kind of thing that people just don't talk about, generally speaking, where you get stuff that doesn't have futures contracts, that, stuff like burlap and cardboard boxes, stuff like that, that's highly sensitive to the business cycle and the industrial cycle. That, for example, recently, that kind of stuff didn't move with the China reopening narrative. So you had all the speculators rush into copper and crude oil and that kind of stuff, where burlap. I'm not saying burlap specifically, but that kind of stuff didn't move anywhere near as much. So it's that kind of differentiator that, to me, it's less so about the composition of the indices, because again, they've been building these. It goes back to Jeffrey Moore in the '50s, and they've been refining them basically ever since.
Yeah. No, he basically wrote the book on this. I think it's called like Business Cycles or something like that. It's an orange colored book that is really where Locke basically took inherited all that from at some point. So I was asking if you knew anything specific, because at the end of the day, there are only so many things that have long leads on the business cycle. And I don't think it has anything to do with profits. I can't see anything in there, but things that lead by 12 to 15 to 18 or 24 months. I mean, there's literally only a certain amount of things that are cyclical like that. And you mentioned one thing. And so what are those things? It is like changes in interest rates, and it's all rates of change. Changes in money growth, the yield curve, even the change in the Fed funds rate. And so, what a lot of people don't understand is I just want to expand on a point you mentioned, which you said that a lot of their indicators were starting to roll over before the Fed started to raise rates. And the reason is, if you're trying to model the business cycle, it's not the level of the Fed funds rate you're going to use. It's the change in the Fed funds rate and the change in money supply growth and the change in mortgage rates or long-term rates, or the change in the yield curve, which is obviously a function of those. And so if you think about it, money growth, M1 money growth, which exploded during the pandemic to the upside, M1 money growth peaked in February of 2021, which is right around where the change in the Fed funds rates peaked and long-term interest rates peaked. So, when you're modeling, and a lot of the charts, I show a lot of these charts, like the change in the Fed funds rate, that's how you model profit cycles and GDP or PMIs and things like that. The irony is that the beginning of a tightening cycle, if you really think about it, it doesn't actually begin with the Fed raising rates. In other words, and think about it, and the same thing for any of those variables I just mentioned. It doesn't begin with money supply contracting or 10-year yields going up necessarily. It begins with the period at which these easing cycles that always precede tightening cycles stop from a rate of change basis. So so that's why sometimes these long leading indicators can lead the actual beginning of a first rate hike. Now, if you think about all the slowdowns we've had in history that didn't have anything to do with the tightening cycle, let's think about. Even last year, the economy slowed for a number of reasons, but part of it was that we basically exhausted all the benefits of the easing cycle, right? So if I'm easing and easing and easing and easing, and I stop easing all of a sudden, or if mortgage rates are going down and down and down and down, and then they stop going down, that is a effective tightening. It's never something that's going to send us into a deep slowdown or a deep recession, which is what we actually need to get, which would need the Fed to actually raise rates and mortgage rates to go up. But I think that's an important point that is getting in not too deep in the weeds of macro forecasting, but it is about rates of change, and that's why those indicators did start turning down before. And that's important because this Thursday, which is March 16th, is the 1 year anniversary of the first rate hike from the Fed, where they went 25 basis points. But again, all of these other indicators, change in the Fed funds rate, change in long rates, change in the yield curve, have all been flagging a slowdown up until now, even though it had nothing to do with a first rate hike, because we had gone from such easy conditions to basically neutral conditions, which again is a net tightening, not a big tightening, but it's a net tightening. Now going forward, and this is why people don't, I think, appreciate the lag of how long it takes these things to happen, which is why they're asking, oh, is this tightening cycle even having an impact? That is all ahead of us. If we think about why the economy slowed down over the last year, it's not because the Fed raised rates, at least outside of housing. It's probably more about that slight mild tightening from the end of the easing cycle that obviously stopped well over a year ago, plus the pandemic issues going away, supply chain issues going away, and all of that. So like when we look at manufacturing PMIs that are below 50 in many countries around the world, that's not really because the Fed's been raising rates or other central banks have been raising rates. That is largely ahead of us, which is obviously kind of a scary thought, but that's just the reality of these historical cycles. So that was one of the first things I just wanted to touch on. I agree. I think you made a point as well that it's been a long time since people have seen this combination of tightening that has preceded every single recession. So, I would stick my neck out and say there are parts of the cycle that do repeat, and it's those parts of the cycle that are at the core of why we have a business cycle and why we have recessions. At least going back to the 50s, every single recession was preceded by three things. And I've said this a bunch of times on Spaces, but it is when the Fed's raising rates, when you get a corresponding commercial bank tightening cycle, tightening lending standards, which today we have in spades, and an inflation problem. And an inflation problem doesn't have to be a 40% rise, 40-year high in core headline inflation, which is what we had today. Even in 07 and 08, food and energy inflation was up 15%. That's an inflation problem. And that's the worst kind of inflation problem for U.S. consumers that have consumption baskets of 30 to 40 to 50% of food and energy. So we've had inflation problems before every recession, not broad ones like we have today, but it's really in food and energy inflation, which has been the big delineating factor between a Fed tightening cycle that leads to a soft landing or one that leads to a hard landing. For reference, in 2018, food and energy inflation was about 3%. In 1994, which preceded the 1995 soft landing, food and energy inflation was about 2%. Last year, food and energy inflation hit 23%. In 2006, 7, and 8, we had 15% food and energy inflation. In 1990, 1991, similar backdrop. I think we hit 10% food and energy inflation. So from the highest starting point, it's all about probabilities. And these are the highest probabilities from these three factors that have preceded every recession, or at least had not been present during soft landings that we have today. And they're all flagging the same thing. And so I guess that's kind of part of the point I wanted to make. And then a lot of the pushback around, well, it's not '08 because of all these reasons. We're not rate sensitive. Housing obviously plays a huge role into the magnitude of a downturn. And in 2000, housing, in 2001, in the recession in '01, housing basically went sideways. There was no downturn in the U.S. housing market whatsoever. If you look at building permits, housing starts, certainly prices, nothing went down. We just went sideways, which gave us the most mild recession in U.S. history. And then the opposite, 9 years later, in '07, '08, or 8 years later, obviously one of the worst recessions, housing crashed. So this housing backdrop is problematic for different reasons. It's already a lot worse than 2000 in terms of the downturns in pricing and activity. And we haven't even seen job losses yet. And again, that goes to the spike in interest rates here. So that's kind of just, I guess, what I wanted to lay out in the back, in the highest level kind of stuff, before we start getting into the nitty gritty, which is where all the noise, often gets brought up.
Yeah, if I could just throw something in here quick, because it segues perfectly, I think, with what you just said, Mike, is there's a New York Times article by Mark Holbert from June 10th of 2007 entitled, "Is it just a strong market or the bubble part 2?" Okay, and the reason why I bookmark it is I come back to it periodically, obviously. And in it, he references an academic study called Overreactions, Momentum, Liquidity, and Price Bubbles in Laboratory and Field Asset Markets, right? It sounds like an academic paper, in 2000 in the Journal of Psychology and Financial Markets. And I won't read all of it, but I'm going to read one section here where he's talking to one of the authors, Professor Porter. Is that investors become, and they studied 150 simulations, various types of investors and education levels, and basically studying bubbles and manias, so through simulations. Is that investors become largely immune to bubble-causing behavior only after living through the bursting of 2 successive bubbles. Because of this, the typical pattern is for a burst bubble to be followed by a somewhat less extreme version of the original. Stop me if this sounds familiar. A phenomenon that some call an bubble echo. This pattern has appeared so consistently and so regularly in psychological experiments, Professor Porter said, that you can almost set your clock according to it. Right. So the basic premise of this article was that what was going on in the equity markets were not really emblematic of an echo bubble. And that wasn't actually, the professor was bearish at the time, but that the equity markets weren't displaying an echo bubble. What I would argue is we're coming off of a dual echo bubble, right? You have of course the real estate market's different than '08. It's never exactly the same. Of course, the mania coming out of the COVID lockdowns in equity markets are different than the dot-com bubble. But they're both kind of dual echo bubbles, and they're displaying many of the same characteristics. So I just wanted to throw that in there.
That's actually one of my favorite papers. So you put a big smile on my face because I haven't heard that in a while. But and the issue with that, in reality, is that we don't have bubbles that happen back to back to back to back. Is that generation? People forget. A new generation of investors comes in, and people forget. And that was kind of one of the last things I wanted to say is that this combination, this backdrop we have, that again, it just increases the probabilities of problems. We have an inflation problem. We have a Fed tightening cycle. We have commercial banks that are tightening standards. When things go bad, it's hard, you can't call that an accident. Yeah, I often tell my wife I don't really believe in accidents. If someone was texting and driving and they crash into somebody, that's not an accident. Somebody was doing something stupid that they shouldn't have been doing. That's again things. So that's one example. And as things start to break here, and I think most of the problems we're going to find are when jobs get hit. These are not accidents. These are conditions that stem from these higher probability backdrop that bad things are going to happen because we're tightening the backdrop from a very loose backdrop for long periods of time. And today it is now 16 years. It's a very long time. It is a record period in time. If you go back 200 years in history, as far back as you can go, there's never been a period of 16 years where between these three conditions of inflation, the Fed, and commercial banks all tightening at no point between '07 and basically coming into this year or last year have we had those conditions, and that is by far the longest time in history. So there's a lot of people obviously in the industry that weren't working in '07, or that even though that were working have just their muscle memory has softened out and recency bias has taken over.
Yeah, and the other part of that, again, just based off of what you just said, is that this is not only the United States. That's what makes this exponentially more dangerous from a cyclical perspective, is that this is a global phenomena in a synchronized fashion where you've got global central banks cutting, basically chopping away at the business cycle in the most synchronized fashion in history. We've never seen central banks in uniformity tighten the way that they've been tightening. So again, probabilistic. What does that mean?
Great. So let's turn the conversation a little bit to, and I want to bring Tom Thornton in and Dave Nicoski. So this question's for, well, I'll tell you what, let's go to Tommy first, and then I want to get in Dave, and then I want to get into particular Silicon Valley and what this might mean. So, Tommy, give it to you for a few minutes, and then turn it over to Dave. Welcome,
Sure.
Tom.
Hey, everyone. Well, just I have to say, Kayfabe, that was fantastic. Really surmised perfectly, and I will say, there's never a similar type of crisis that happens exactly the same way, and they start from different places. We've seen, in my career, I've seen different types of crisis that happen. I remember long-term capital was something that it sort of came out of nowhere and was there was a lot of accelerant in in the markets on the downside, a lot of fear in the markets, and um, the the banking, you go back to New Century, and New Century Financial was a subprime, and they blew up, and that was sort of the start of the financial crisis of what we saw. And central banks, I think it was Ben Bernanke said everything was contained, and now we have, again, I don't think that 2020 was a real recession at all as well. I think it was something unique and um, different, and something we'll probably never face again, hopefully. And this one is coming at a time where we have this raging inflation problem. The Fed has a mandate to tighten pretty hard to control inflation, and I've said on Spaces basically all year, there's two issues that I think we're dealing with. One, inflation doesn't come down quick enough and stays sticky. And then the second is if inflation starts to reaccelerate. And that is something we saw a lot in the 70s, where we saw these cycles where inflation dropped and then it came back up in different aspects. And, Tuesday's CPI is going to be really, really important. Uh, I honestly, I think we're going to probably see a CPI that's going to be a little hotter than what most people want. I think that's the problem. It's going to be sticky in a lot of different places. The Fed's in a tough place now because they have this bank that is blowing up, and I think we're really in a wait and see mode because I think honestly we have to wait and see what regulators are going to do. I mean, Janet Yellen was basically out today saying that they're going to do their best to um, help depositors, and they're not going to bail out the bank, partly because they have regulation in place after the great financial crisis where they don't need to bail out banks anymore. That's going to be challenged. And the thing is also, you have a lot of bidders that are coming in to try and scoop up the assets from SVB. And that's a good thing. Capitalism has companies that fail, and they fail sometimes um, for all different types of reasons. This one, you can lay blame on a bunch of things, whether it's the tier one capital that they mismanaged, bought long-term uh, debt that out and not hedged. And believe me, there's 100 different people on this spaces that have a much deeper understanding of all those uh, issues, why they are blowing up. I think it's just important to see what is going to happen. It's probably going to happen, I would say, before the futures open today. But I think that the risk is still there uh, for overall in the market. And I think the big problem is that this will create shockwaves, and it's kind of like an earthquake. And I used to live in California, and I've been through a few pretty good sized earthquakes, and you have these aftershocks that come shortly after, and you never know when they're going to come. And that, I think, is going to be a problem. I think you're going to see the tech sector uh, have some real problems as far as demand. And when I say that, you have all these startups and companies that are within private equity firms that are private, venture firms that have uh, private companies that they're starting up. Those companies are going to have to cut back on their spending. And that spending is going to start with AWS, cloud. You're going to see hardware sales slow. You're going to see software sales slow. And that's going to take time. That's going to be quarters. So I think that this is a much bigger problem longer term in the micro for these companies. Uh, but I'm really I kind of heard of the Bill Ackman spaces yesterday. I've been seeing the venture capital guys, the all-in people. They're really panicky right now, and I I think that I mean, kind of goes to show that you're a libertarian until you're not, and then it gets real. But look, this is what happens when the Fed raises rates and there's a hiking cycle that happens. Things break. It was bound to happen, and I think that Kayfabe and Michael, you guys said it perfectly with the macro situation of what's happening. So it's an unfortunate situation. I feel horrible for people if you're affected by your money's tied up, or look, God forbid it is lost. It's a terrible situation, but financial firms are fragile, and we have to remember that. I've been through a bunch of different cycles. I've seen financial firms blow up and die. I was in the Bear Stearns office, their headquarters, the night before they filed and they blew up. Uh, a friend he did this Techapalooza, he called it, and it was like a tech trader get together, and we all shared our best opinions. And they had this giant conference room that was like circular, big table, and all they did that night was talk about Bear Stearns credit, and they were fine. And when I was walking down, and if anybody's been to the Bear Stearns, now JP Morgan headquarters in Midtown, there's this like beautiful wood staircase, and I was walking down. I swear to God, I was looking at people, and I thought it was like the Titanic, just like dead people. That last scene where they all came back, because everybody was so glum. But look, things happen like this. It's finance. There's risks, and people forget about risk. And I know that's kind of oversimplifying it, but financial firms are fragile. And I worked for a hedge fund that died an untimely death as well. So it's very, very tough right now. So I'll let you guys continue.
Thanks for that, Tommy. Let's go to Dave Nicoski. And Dave, I don't know, whatever's on your mind. And I do want to get to the question as to, Dave, you can address it, or if you don't, some of the others can. But I do want to get to the question. Everyone has an opinion about what the likely response is of the regulators. Dave?
Yeah, I'm here. Thanks for having me on, George. Thanks for everyone joining us. I think I'm just going to go back to my thoughts on our call that we did on February 23rd, and I had indicated that the financials were the canary in the coal mine, and as part of my three-legged stool, observing trends, and unfortunately, I have the easy part compared to these guys and guessing the market cycles, I should say, with obviously a lot of information in their hands. But fortunately or unfortunately, I have to look at charts and come up and deduce what I'm seeing. So my hat's off to you guys, because I know a lot of you were in that camp. It's just timing it is the real uncertainty for anyone. And fortunately, I get to look at charts and go look at inflection. So I've got the easy part. Thanks for making the charts for me, guys. You know, I went back after Tommy's comments about long-term capital, and just to give you an idea of the day that long-term capital was announced, the market moved down almost 2.5 weeks, and for a total loss of 15%. To give you an idea of what that circumstance did, that would put us at 32.82. And I don't know that we get there, but just some perspective on it. I don't, like I said at that time back on February 23rd, the market reached our objective to the upside, and we were, swinging bearish on the overall market, based up, again, what I saw in banks, what I see in the consumer discretionary sector, the retail sector. I can't say the charts look favorable. Industrials held up the best. I think any high PE stock. I think, not knowing price discovery on housing, we just don't have enough, supply on the market. So you really don't have that discovery if job losses do go up. And I think that, illiquid assets, derivatives, that type of thing are going to be questioned. It's going to be shoot first and answer questions later. So I think there's going to be a price discovery mechanism within the derivative structure, and that to me is the other tail wagging the dog. Mark to market, obviously, as we can see in this SIVB financial statements, that they weren't doing it, and I think a lot of these regional banks don't have the means that a big Wall Street institution can do in terms of hedging, because they haven't had to do it. You're employing someone for 12 years, you didn't have to do a thing, right? And all of a sudden this last year, it's creating shockwaves. I still think that we're in season 2, episode 3 of knowing what rates are going to do. And the uncertainty is, I think, going to push investors to the sidelines in terms of the overall equity market. We will find a bottom. It's not the end of the world, but, I think it creates a lot of uncertainty. Should I have not ended that way, George?
That's actually a good thing to talk about. Even if we get the big bad news that comes out, that's certainty, and we'll be able to figure out what we want to do after that. Markets hate uncertainty, and that's the point I think you're saying. So if we do get some certainty, I think the markets could get some relief out of that. And even if it's bad news, I think that you get that, and we could see some some stability that comes into the market. But again, we just all have to wait and see what the headlines are going to give us later today and tomorrow morning.
Yeah, I think, for the most part, periods like this resolve themselves through time. And pinpointing a day, is it one day later? Is it 5 days later? I think it's going to be time. And it's not going to be measured by, you recall the bear markets, coming off of, 2000, the 2000 peak. You were having, on the overall equity markets, you were having, 4 to 6% swings in days. And they're very, very traumatic and very difficult to time. But at some point, I think that apathy will take place, right? We'll get volatility levels to come down, but I'm still skewed bearish. And the question is even if we get through the uncertainty of this bank, what is the other one? I would think that many banks that are concerned about it, if they file shelf offerings, they're going to be put under the gun too. That's the problem here. If anyone does need access to capital to raise, their balances on their balance sheet, that's, I guess I'm going to be scouring S3s, and I'm a technician, and that's what I'm left with. But yeah, uncertainty. My other concern would be that, the trust in the U.S. financial system globally. What impacts will it have on the U.S. dollar? And when you look back at the gilt issue in Europe until they, until the government stepped in, that stemmed the hemorrhage in the euro and the UK pound. So, I would expect that we're going to have pressure on the U.S. dollar. I think gold as a commodity did extremely well, and the gold stocks did not follow. So you're seeing hard assets with real-time pricing are better than something again hidden on a derivatives desk or illiquid market. And that's going to come in the form of commercial real estate and mortgages.
Right.
Can I ask, I'm sorry, George. Can I ask David and Tommy something real quick?
Yeah, go for it.
So I try to conceptualize some of this as like constituents of the market, right? So you have the buy the dip people that, I don't think they've been deprogrammed or punished enough, clearly, given investor behavior. But if you look at, for example, like Dave, I mean, with what just happened in penetrating the 200-day and breaking in the uptrend line off of the autumn lows, like what technicians are not flipping bearish here, what CTAs are, after having turned positive, getting blown up now, and even Tommy from a DeMark perspective, I mean, I don't see any, huge DeMark setup, for example. Like I'm having trouble looking at or finding outside of specific short-term, 1 day, 3 day kind of, news-driven movements. But if you're thinking about this on a cycle time frame, I mean, to me, it looks like we had kind of a classic autumn low. I thought we'd get one more move lower, but the Tiramos article that first mentioned pivot blew me out of the water on that. But we've had that kind of, B wave higher, as the Elliott wave person might say, into the late January, and we've rolled over here. I mean, again, if you look at monthly charts, that's what bear markets do. This is a classic cyclical bear market behavior. And I just, with all of these violations of constituents processes, I mean, like I'm not sure and there's not a lot of shorts left based off of what happened in the first month and a half of the year. Like who's the constituent to add money here incrementally?
I would agree that going into this, that the data that we look at hasn't seen a lot of shorting in this. And the one thing I can say, I mean, that I guess I should say the amount of shares short and the notional dollar volume isn't that big. But one thing that's starting to show up on my radar, just technically, is that the Goldman Sachs most short baskets are all within the last 5 days down about 10%. And usually when they get down around, let's say 15%, that starts to wake me up that these are, the shorts are getting a little overdone right now. So you could see some really wild moves this week. And let's not forget, we have a whole new class of investors that in this period that we didn't have a year ago, and that's the short-term option call buyers, which could cause, and put buyers, which could cause some pretty violent swings intraday. So that's something else that we throw into the mix that is really unprecedented.
Hey, Tommy, I mean, without the shorted stocks, look at what they did the first 6 weeks of the year, though. Like, what is 15% drawdown when they're up 80%? Or like, high beta stocks, you could say the exact same thing. And I'm not even trying to debate about where they're going from here, because obviously that's going to all be a function of how this plays out in the next few days. But like high beta stocks, the S&P high beta index, an ETF of S&P 500 stocks, was up 26% in the first 6 weeks of the year. They're down 10% now. Like, how could that get you excited?
Get excited in what way?
Well, like the same, I'm just making a parallel between the Goldman Sachs shorted stocks, which are even, kind of the junk of a high beta portfolio, that those are down 15%. Unless I misheard you, is that trying to make you interested to buy them, or something's wrong?
Okay, so from the end of the year to the peak, the Goldman Sachs most shorted basket, which I use that as sort of a consensus of typical shorts in the market, and it's not necessarily the best and perfect um, way of looking at things, but it was up 41% in January, and then it's now down 22% from that high. We're still above the December lows, and sometimes you get these big swings, and then you have this a bit of a mean reversion with the short baskets, and that's, I mean, that can be said for other things as well. But that's just, I like to look at what's going on with the shorts, because sometimes it works well with the regards to sentiment, as far as with positioning and how well people are doing. I mean, for example, if in December it was down huge, the short basket and positioning was offside. So I think that if this goes down, if we see the market go down a bit more into the midweek, and I can't tell at this point, but I think you could see a fairly decent sized type of squeeze higher, because you're going to lure in a lot of new shorts.
That's interesting thread. Let's move on just a little bit further. I want to go to what the consequence of this is going to be, and what is it? Is it just idiosyncratic to Silicon Valley Bank, or as we've seen a lot of stuff in Twitter now showing a lot of other banks that are off sides with big unrealized losses? And I think I'd like to turn to Bobby J to speak on that, and then the Carter. So
Hey,
Bobby J,
George,
Hey,
before
yep.
I have someone that is he has exposure to SVB, and I want to bring him up. So I'm
Please.
gonna
Yeah,
add
yeah,
him as a
yeah,
speaker.
yeah. Bring him
It's
up,
Steve
and
Barrett.
let's do Bobby J. Let's do Bobby J, and then the
Cool.
Carter, and then you're the fellow you mentioned. So Bobby J, welcome. Good to see
Yeah,
you.
hi George. How are you? So I think the big story, it's a story that I've been espousing for a year now, is the unprecedented duration bubble. And what has happened here at Silicon Valley Bank is related to what happened with the UK pension fund. We have assets that are sovereign debt that have declined anywhere from 20% longer term, 10-year and out, down in the case of UK gilts, we're down to 40 cents on the dollar. You would look at the price chart and you would say, that looks like a junk bond, but it's AA3. So what we've had over the past decade is sovereign balance sheets trying to shield credit risk, focusing on the last bubble, as you guys have been saying here, and transmorgifying credit risk into duration risk. In other words, sucking credit risk out of the system, preventing pandemic recessions, and putting fiscal money out, and then growing government and sovereign debt as if there was no risk to that. But in the process, when rates were near zero, they created approximately 50 trillion worldwide in zero coupon bonds. And that has huge consequences. So what has happened here at Silicon is not different from the UK pension fund, and we're only at 4%. The other thing I know for a fact is that the Fed does not want 2% inflation. The Fed and Treasury are one function, and they would like 3 or 4% inflation because that's the only plan. If somebody here could tell me what is a better plan to deal with global debt that is compounding and accelerating due to the number one principle in finance, the power of compound interest, I'd like to hear it. But they want to inflate their way out of it. They tried financial repression and it didn't work. So I think going back to the U.S. banks, I think what we're going to see here is that the Fed is going to and Treasury is going to come out with a statement that they're going to wipe out investors, which is in the playbook anyway. By the way, if I have the process, everybody knows what the process is for receivership. This is not, Bill Isaac. George, you'll remember a guy named Bill Isaac who was head of the FDIC, and Bill Seidman and all these guys that have processed thousands of bank failures over their career. There is a playbook for this. And there is another playbook, by the way, for interest rate risk that the OCC has. And Silicon Valley Bank definitely violated the guidelines of interest rate risk. And, I have two sayings today, and one is, bank examiners cannot work from home. And they have not been on site. They have not been doing their job. And the other thing is the bond market has the Fed surrounded at this point. So what's going to happen is they're going to come out and say that investors have been wiped out, which is going to happen anyway, bondholders and equity holders. They're going to probably offer a temporary haircut to depositors over 250,000, 250,000. And they're going to talk about, trying to give them a workout on the balance. They may try to guarantee 60% of the deposits that are over 250,000 or some formula to prevent a run. But I think that's where they're going. But we are entering a new interest rate regime. And if this happens with a 4% 10-year, you tell me what happens with a 6% 10-year. So that's my kind of short version of what's going on here.
Bobby, you think that's where the 10 years going, by the way?
I think eventually is going, because I think what happens here, if financial stability, we've been talking about this for quite some time, George, you've been talking about it. If financial stability trumps their inflation concern, right, and they always go after the short-term problem, that would not be good for long rates. And now we have another problem, is that the curve is inverted right now. So if you're the Treasury and you have all this debt rolling off and you have to issue new debt, are you going to issue T-bills at 5%, or are you going to issue 10 years at 3.8 or 4%? And my guess is that we're going to see what has happened is the duration, which is the price sensitivity to interest rates. It's not the maturity. It's the formula. Kayfabe knows this. The price relationship to yield changes. What's going to happen is that they're going to issue more longer term debt. We already saw the duration of world sovereign debt double since 1990 from 4% to 8%. And that's why prices have been so sensitive. And that's why there are bonds on Silicon Valley's bank sheet that are probably down 25-30%. So I think, George, eventually we're going to see 10-year yields go to 10%. Now, if we have a recession here, yields will trade down temporarily, but I think longer term we're in a new rate regime.
So that's so this problem's only going to intensify from here. Is what you're saying, Bobby?
Yeah, I there's no way out of this duration bubble. You know,
Right.
the bond market has the Fed surrounded.
Mm. Right.
So I think there
And
is a way out, but people don't want to know what that answer is.
well, is it pain free?
No, it's a horrible recession and major credit losses at banks, which is to me the big problem right now. I think this Silicon Valley Bank issue is a distraction. Not an intentional distraction, but I think what's starting to occur in the commercial real estate market is this is why I say that the better, again, these are always different, but the better analogy is the S&L crisis. The higher rates, they extended risk. It was more of a risk extension there as opposed to duration. But again, you've had 13 years of a commercial real estate market that has not had any kind of reckoning. And all of the stuff that you're talking about, Bobby J, transmuting into that. And now you've got this duration convexity problem at these banks with this catalyst, with work from home, with a potential severe recession on deck. I mean, with us having overbuilt massively in retail square footage and all these other things, and now the multifamily, and it's
So Kayfab, if indeed what you're saying comes true, what happens? It means more bailouts and it means more expansion of the government balance sheet
I
and more
think
duration.
eventually, but again, if again, I've been saying that this is a Frankenstein of 1930 and 1973. So, and the reason why I say the 30 example is we had a fake recession in 27. It was inverted there. We had a huge residential property bubble in the mid 20s, like the Florida one that Mr. Ponzi was involved in, for example, that then transmuted into a commercial real estate bubble. We flipped that this time, where the commercial property market kind of peaked first, and then post COVID, coming out of that fake recession, it was the residential side that reinflated. But go back and look at what happened in the federal banks versus the state banks and the regulatory changes in the 20s that facilitated that. It was basically a big consolidation to the federal banks, and it was it was like an extinction level event for state banks. And obviously, it's not going to be the same because we're in a different regulatory regime. But look, this is why I tweeted today. Look at all of the policies that supposedly came out of the GFC because of too big to fail banks. What did they do?
They made them bigger.
They anchored the power of too big to
Right.
fail banks and screwed small and mid-sized banks.
Right. And by the
So
way, the bigger banks don't want to take on, and adopt these failing banks, because then the regulators turn around and they fine them for countrywide credit, or they fine them for WAMU and for other problems that they've had. But I'll say one last thing about this, and that is, if you look back at 1969 when rates were going up and then it caused a recession, bond markets rallied again. But it took almost 30 years for rates to get back down below 4%. And anybody who thinks that we're going back to this near zero or sub 2% yield environment is out of their minds. That's all I got.
Bobby J, what do you have to say to a lot of stuff going on Twitter? People showing mismatches for Charles.
Absolutely.
Charles.
Absolutely.
So
That's what we do. That's how we reach. We can reach for risk by, look at, there's 3 or 4 ways you reach for risk, George. You know this, right? You go down in quality and credit, right? You price credit. Another way to price credit is to lend to a lower quality credit at the same rate, right? So uh, there's credit risk, there's duration risk, and when you're cheating and you're going out the risk curve, the job of the Fed is to push people out the risk curve, and this time they pushed them out the risk curve and created a liquidity problem and duration mismatches. So I worked with the Federal Home Loan Bank I was working for a company called Sendero, and we were putting in systems for interest rate risk after the S&L crisis. And this should not be happening right now. And when you look at deposits that are very, very liquid and very short term, you know that that is hot money. And now we have yields competing at 5% on a T-bill. So why should I be keeping, aside from deposit safety, but why should I be keeping my money in a bank at 1%, 2% when I can get a T-bill rate at 5%?
So when you look at something like Schwab or First Republic, what do you see, Bobby?
Well, I don't know about that. I think they're going to try to come out and really batten down the hatches. And I don't know the answer to that, George. I mean, the good news with Schwab is you can go into Schwab and you can buy T-bills through Schwab, right? So there's not necessarily a need to move your money out. I'm not saying that we're not going to get an irrational response, because I can't predict that. But
Bobby J, aren't they kind of trapped? Because to your point, like, people are already talking about, the Pavlovian monkeys waiting for a Fed cut right away.
Right.
Is if they cut right now, they might make the balance sheet problem at the banks worse, because they could de-anchor the long end.
That's what I agree with that. I agree with that. It might take a while, right? And if and to Kantrow's point, I think we will go into recession, and we could get a 10-year rally in the process, but that would be, for me, that would be the last hurrah.
Could I jump in? So people have been talking about this broader great rotation from equities to back to bonds for years now. Obviously not in the last few years because rates went back down, but I remember what was it, back in 2013, 2014 during the taper tantrum. It never really happened. And is this event not the greatest advertisement to push people further, regardless of the outcome here? I mean, I was joking with George. I was talking to George this morning. I was joking with him. I've had my daughter's bat mitzvah money, which was 5 months ago, sitting in an account which I learned was earning 2 basis points. Now, shame on me for letting it sit there. I didn't want to put it into stocks a year ago. But this morning, I finally went there, not because I'm worried about the bank at all that this money's at, but I'm like, all right, finally got me off my ass and putting it into I bonds and the rest into treasury bonds.
Right.
And so this is going to propel that rotation regardless of the outcome, because people have been massively underinvested for the last 15 years in treasuries, and maybe this gets people off their ass, like me. This money was sitting in the back corner, which I kind of forgot about. And so isn't this a broader issue immediately, regardless of the outcome?
Yeah, it
for
is.
banks' profitability?
Yeah, no, it is. And we have seen deposits level off over the past several quarters. I'll put that chart up again on Twitter, but deposits are declining a little bit, and that's part of the reason. But also bear in mind, there's something else I want to point out, that because loan demand hasn't been fantastic, we have seen banks getting into the business of owning securities. So the securities book at banks from 2008 to 2022 went from 15% of total assets up to, or maybe even lower, 14%, up to 24, 25% of total assets. So banks and Silicon Valley Bank, I mean, I think their loan book was only about 35% of total assets. So why are they expanding their deposit base? And why are they in the business of basically doing a treasury arb? In other words, deposit treasury arb. And so a lot of banks have done less lending and more investment in treasury securities.
I want to go back to a point that I think Kayfabe mentioned about, again, it's about risk. And if we think about why markets rallied in the last 4 months from the lows of October, is because risks went away. wasn't because earnings were going up. China came back. That's, that helped, I guess, incrementally some parts of the world. But, if you look at U.S. earnings, nothing's really going up for the last 4 months. The aggregate estimates for this year have gone down. Estimates for next year have been down a little bit, but obviously sell-side analysts don't really start to change those until we get closer closer to next year. And so this whole rally in equities has been PE expansion, which goes, again, that's what a bear market rally is. It could turn into a bull market if you get an earnings catalyst, i.e. the economy rebounds. But, and that's, sure, we can debate that, but I certainly don't see that happening. And thus far, it hasn't happened in earnings estimates yet. So if this is going to remind investors there's more than zero risk out there in the markets, which kind of effectively was priced in at 4,200 on the S&P and 4.5 credit spreads, high yield spreads at the early February. I mean, that's the stuff that just seemed insane to me. It's just that the pricing of risk went so low, and that was when all the no landing nonsense came about. And so again, the parts of the cycle that repeat themselves in every cycle are the behavioral ones. We've just seen that play out.
If I could just make one quick point, because Bobby J referenced the fact that they are actually targeting, let's say, 3 to 4% inflation. They do that by what I joke, focusing their mandate, so-called, on phony baloney inflation, which is core PCE. Right. So when they say they're targeting 2% inflation, that's what they mean. And that peaked at 5.4% earlier this year. I mean, anyone who shops on planet Earth knows that number is completely ridiculous, right? And has been. It's nowhere near reflective of what's going on in the broader price level for the consumer. So by them, and we know historically that they did various things to underreport inflation intentionally for various reasons. So, I mean, them getting that back to 2% doesn't mean that those of us on planet Earth are going to be paying 2% higher prices. That de facto is probably 4 or 5% for reality.
Yeah, I agree. I mean, 2% inflation is not going to work in terms of revenues and tax receipts.
I think George might be having some issues, but what I wanted to do is I wanted to bring up a person who does have some SV.
Cantor, can you hear me?
Yeah, Twitter's like a bucket shop.
Yeah, I don't know what the hell's going on.
It's like Robin Hood. They can't handle a lot of activity if you get a crisis.
Just give it 1 second here. Let's get this thing going again.
Hey, George, before you jumped off,
Yep.
I wanted to bring up a person who does have SVB exposure. He and his heading is it sounds like biotech, maybe crypto stuff in there. That's his investments. Just want to get his point and maybe what he's hearing from them directly, if he's
That'd be
hearing.
great.
So
Go for it.
I'm looking for him.
Go for it. Let's get Amy into the mix, and hopefully the room will repopulate. So, Amy, good to see you. What's on your mind?
Hi, guys. Good morning or good afternoon. I don't know what time it is. Daylight savings time has me all messed up. Just so I'm trying to take like a broader view of SVB. I mean, their deposits tripled, right? They have all these VC companies. People are throwing money at them, right? So they're not making loans. So they go into mortgage-backed securities. Granted, the duration was not a wise choice. The 10 years weren't a wise choice, but I mean, they weren't actually making like risky loans, right? And before Peter Thiel told everyone to take their money out of the bank, they weren't really in. I mean, they had a $1.8 billion hole, right, from the book they sold off. So, I mean, that's, I guess, in the grand scheme of things, grand scheme of things, I don't think that's an insurmountable amount of money for them to raise to shore up their balance sheet. So I guess I don't, this whole freak out, Jason Calacanis and Bill Ackman and all these like freaking out and all this stuff, like, is it really justified? I mean, is this not something that the FDIC can just, the regulators can go in there and get fixed up? I mean, I'm thinking about going long banks tomorrow, truthfully. So I just wanted to get y'all's opinion on that.
A Fed cut doesn't solve this.
Absolutely not. And they're not going to cut. Like, I don't know why that. Okay, that's another question. Peter Thiel's been pretty vocal about.
I think we just lost Amy, George.
Oh boy. All right. Well, this is turning out to be a bit of a freak show. The way
Government intervention.
the way Twitter.
Mr. Capote's just arrived, though.
Yeah, now,
I don't
yeah,
know.
the varsity has just shown up. The
Oh
JV
God.
can get off the field.
Oh God. Is there a? I'm trying to get Amy back. No, Amy's back. Amy's back. That's fair. Okay. And Mark, good to see you. I inadvertently made you co-host, but no matter. Good to see you. I heard. I mean, congrats. You've been front and center on this whole thing. So, why don't you share your wisdom as to state of play and what this means more broadly for banks, not just not just Silicon Valley.
Well, I think there's some stuff that's bearish, there's some stuff that's bullish. The stuff that's bullish, even though it's ironic, is if the government and the powers that be can finally let the zombies fail and let people who have taken undue risk get cleaned out and understand that risk, if you take too much risk, you do lose and lose big. Long term, it's very positive because the good actors will keep doing good things and the bad actors will go away. The thing that's bearish and really negative is if they bail out all these crybabies who brag that they borrowed money at zero rates and made 10 to 15 times their investments. These guys who have exposure should get cleaned out so they learn what risk is about and they get knocked off their high horse. So it's going to be fascinating what the government pulls together. I mean, I talked to Josh this morning, who's a very plugged in guy, and he thinks the government's gonna come up with some long-term, deposit assurance fund where the banks kick in, and that's kind of a short-term fix. But these banks who are undercapitalized are going to have to raise a lot of money in equity, and they're going to stop their buybacks, and they're probably going to eliminate their dividends, and they're going to have to run these banks like banks and make good loans, not bad loans. And a lot of these companies who keep borrowing money at no rates and who keep funding huge losses to come up with the 47th food delivery app or the 69th taxi app. I mean, these guys should go out of business and they should, demand should be destroyed, which again, ironically, is what the government wants. I mean, this is a closet tightening in a big way without raising interest rates. So the government now has a chance to finally unwind and fix all the mistakes they made in 2008 and basically say, if you've fucked up, you're going to get destroyed slowly, but you will. And if you're a good banker, you should be rewarded with market share. So, I mean, it's very, very, very bipolar. And this isn't a time where few people do the actual work, where everyone wants to be right all the time, where shorts have been obliterated basically year after year. So there's very few running around. And the Cubans, the Kevin O'Learys, the Scaramucci's, the Ackmans, the whole Silicon Valley crew, these guys all need their clock cleaned in a major way because they were just bull market cheap money players. So that's my bigger picture view. I have no clue what the government's actually going to do tonight. And actually, I don't care because I think bad guys are going to get what's coming to them. And I'm not a trading type. There's people better at that than me. But it's the Silicon Valley Bank is a plane flying at 40,000 feet falling out of the sky. And I put what went down. Everyone has their reasons. I put this on Peter Thiel. He basically sort of caused it in his own ways and is responsible for it because the bank, given time, could have fixed this all up. But clearly, Silicon Valley Bank did something to him because him and his companies were probably big customers. They did something to piss him off. But I enjoy seeing Ackman squirm. I enjoy seeing all these VCs get what's coming to them. And people need the free markets to actually work. And time will eventually fix this. And if the market goes down, it goes down. So what? Not the first time, won't be the last. So that's
Tom, are you there? Tom,
I am here,
yeah.
George.
I don't know what is going on with this room. This is insane what's happening now. So,
Well, Mark was really on a
yeah,
roll, and I really enjoy hearing his very frank comments. And I know we have a bunch of other people that want to get up here. I'm trying to get see if Jim Chanos wants to jump up here,
yep.
and a few others.
I see
But
it.
really, I have a question, Mark.
yeah.
In the real world, what you're saying is, the government will let the bad actors and bad companies and the froth get taken out. But in reality, we're talking of that's a political issue as well. I mean, with the Democrats, do you think there's something that the Democrats are going to have, especially since it's in California? Do you think there's a bias there that won't let that happen?
I don't know. That's a good question. I just don't know. But I said last night, I mean, how much dry powder do the VCs and private equity have right now worldwide? I think it's in the many trillions of dollars. So this can easily be fixed if people want to put their own skin in the game rather than just keep leaning on the government for these free lunches. I mean, all these guys, these self-proclaimed billionaires, have far more money than brains, and they've all made it on the backs of easy money, zero rates, funding these losers. So now that their bank has failed, or JP, my view is JP Morgan will buy them out, or someone's going to buy them out between 50 cents and $5, and they'll keep it going. But now that this idea has failed and money is no longer free, let's everyone who's been a huge winner, let's everyone ante up and put their own money at risk rather than the government all the time. I mean, you can't have it all ways and watch the upper middle class and lower just suffer, because inflation and the cost to live is through the roof, and it's not going to get better anytime soon. So part of the solution should be, yeah, the government may back bigger deposits, fine. But all these guys who've made huge sums of money over the last 20 years, if you guys want a car on the racetrack, ante in, pay up. I mean, TPG, show up. Rather than buy out or leverage buyout all these crappy companies, create a bank that actually banks and works and doesn't make stupid loans to the wine industry or these crazy apps or fund all these crypto money launderers. So politically, I don't know. Politically, it's hard to say because the average person in California does not have 250,000 plus in Silicon Valley Bank. It's Andreessen and those clowns and the Sequoia guys and that bunch, and they deserve to get their top knocked off. They really do. So politically, I'm not a political guy. I would never make it in politics, but we'll see. It's gonna be interesting what they scheme up. And
Thanks.
Janet Yellen is part of the problem, as is Summers and all these people who came out of the GFC. I mean, it's just a mess.
Thanks for that, Mark. Let's bring some others into the conversation here. Let's go to Jim Chanos is here. My good friend Jim. Good to see you. We've got the Carter. So Jim, if you're there, might you weigh in on what you see going on specifically Is this just a one-off, or is there a more widespread problem with funding problems for a lot of other banks, Jim?
Hi guys. I want to apologize in advance because as soon as I logged in, you started having technical problems, and we all know why that is. So, in any case, that was a joke. I don't think this is systemic. I agree with a couple of your previous speakers about the analogies to the run-up to the S&L crisis. We have a number of financial institutions that have duration mismatch problems, as evidenced by what happened with the UK pensions, as one of the speakers pointed out so aptly. Most of a lot of that risk ended up on central bank balance sheets because of QE. There could have been a lot more in the financial system. There's still a fair amount of it. And consequently, you couple that with the bond-like investment attributes of commercial real estate, where people have been doing deals at cap rates that are just completely insane in the past 5 years. I mean, apartment buildings at 3 caps, offices at 4 caps, industrial. I saw a 2 cap deal a couple of years ago for an industrial space, for an Amazon leased warehouse in the Sun Belt, and these kinds of things, which are really bond equivalents. There has been no reckoning on terms of balance sheets for those types of things, with maybe the exception of offices and a few other issues. And so I think that there's a fair amount of this kind of stress in the system. But what we saw with Silicon Valley was much more akin to Orange County and LTCM. The difference this go around is that I don't think the Fed is going to use either incidents to reverse policy and loosen, which they did after Orange County, after raising rates abruptly in early 93 or late 93, early 94, or LTCM when they began easing policy, which led us to the last blow off top in 99, 2000. I don't think they can do that this time. So we're going to sort of hopscotch from various different duration risk problems and hope to hell it doesn't turn into credit risk problems. What I have been stunned at in looking at our portfolio is just how sanguine the credit markets have been relative to what's happened and what's happened to rates nominally. And credit spreads are still, I think, reasonably tight for what's happening. And I think that's something that is yet to happen. But I don't think Silicon Valley is systemic. One other observation I'll make is that, man, oh man, if you don't rethink the financial incompetence and innumeracy of Silicon Valley after what happened this weekend, you've got to rethink the way you look at the world financially. I mean, whether it's the tweets, whether it's people saying companies aren't going to be able to make payroll.
Hey, Jim, you before we got cut off here, maybe it was something you said. You mentioned how you're surprised how tight credit is. I was just curious, are you referring to literally the last week or the last 4 months?
I was talking about how tight spreads are.
I'm sorry, yeah, that's what I meant, spreads. Yeah.
Yeah, with everything that's happening in the world, spreads are very sanguine, and normally I would expect to see a widening in some of this stuff, and it really hasn't happened to the extent that I think it might. That event, I think, is in front of us. But what I was starting to say before Elon cut me off was that the other thing that just really underscores this whole episode is that if you think Silicon Valley knows what it's doing financially, you really have to rethink things. And this weekend underscores that. Whether it's the silly tweets from the VCs claiming this is Armageddon and I'm never going to be able to buy another winery again, or just the fact that all of these companies the investee companies from the venture capital world seem not to have a treasury management function that's even remotely finance 101 is remarkable to me. I mean, in Silicon Valley itself, I sent something around this morning that someone flagged me on. Silicon Valley itself had a cash sweep function. And I'm told the minimums were somewhere around 5 million. So literally you could be sweeping your excess cash into treasuries or money market funds every night. You needed, if you're running a cash management program, you keep a couple of months worth of possible needs in checking, and you keep the rest in treasuries or otherwise non-deposit, uninsured deposit categories. I mean, that's just basic business. And these people all seem kind of stunned that this has happened. And I don't get it. And I don't get where the advice from the financial gurus at the venture capital firms was to tell people not to do this. I mean, everybody is sort of stuck in uninsured deposits in a way that just makes my head spin. And so what kind of advice are these guys getting from their sponsors? That's one of the things they're supposed to do. I don't get it. Anyway, and the self-serving, the Fed's got to bail us all out, otherwise Armageddon's coming. Whatever is just nonsense. This is not a systemic issue. I think it is symptomatic of what's happening with duration and rates, but this is not a contagion effort to the banking system and the financial system. Now, it may be uncomfortable for some people on Sand Hill Road, but this is not that. And so, again, more akin to Orange County or LTCM in my mind than anything we saw at Bear Stearns or Lehman. So I think, and by the way, I suspect they're going to find a buyer before the market opens. Based on our analysis of the deposits and the value and what's there, I suspect a Wells Fargo or someone will bid for the corpus of what's left at a very small premium. That won't help the shareholders of the extinguished bank, but it may help resolve the deposit issue. So I suspect that a lot of this may be a moot point by 6 o'clock tonight or 9:30 tomorrow. Anyway, that's it. Everybody have a good Sunday.
Jim, real quick before you go, based off of your comments earlier on the commercial real estate side, is that something that you, maybe not acutely, but as this cycle matures, is that a potential source of a systemic concern of yours?
Yeah, we have a huge short in commercial real estate and have had, for the last couple of years. And I think that what people don't get is that there are a lot of business models that are de facto long duration bond models, whether it's commercial real estate, whether it's, solar panel leasing. I can go down my portfolio and point to one situation after another where it's basically a bond proxy, and yet it's not technically a bank or what you would consider to be a financial. And yet this is what years and years and years of ZIRP has brought us. And a lot of these business models are literally insolvent. People just haven't figured it out yet because they trade as REITs or they trade as green energy plays or what have you. But literally, take a look at a company like Sunrun, which I know others have talked about. I mean, this is a company that's sitting on billions and billions of dollars of 20 and 30-year second mortgages, which are the solar panel leases, at a cash yield of about 3.5%. And financing it, in the debt and equity markets where the bonds are yielding more than 12%. I mean, there's all kinds of stories out there like that just simply make no sense in any kind of normalized rate environment where we were at zero rates and people could play kind of silly long duration accounting games. In Sunrun's case, they use a discount model to discount future cash flows back at 5%. With their bonds yielding 12. It's insanity. And then there's lots of them out there. There's tons of them. Or just projects that don't work. at 5 and 6 and 7% interest rates that were financed at 2 and 3. And then you could just look across the spectrum at commercial real estate, where any kind of cash out for equity is not possible anymore at 6 and 7% mortgage rates, because deals were done at 3 and 4 caps. So the market's frozen, and that is where there may be the first credit risk on bank portfolios at regionals, is reasonably large commercial loan portfolios that where the keys start coming back in a meaningful way. We've seen it in office already. We saw it in retail pre-pandemic, and that'll spread. I mean, warehouse deals don't work. Done at 2% don't work at 6%. I don't care whether you have a tenant that's AAA or not. And so those kinds of things is where I would look for duration risk in your portfolios out there, as there's a lot of hidden bonds masquerading as operating businesses. That's it, everybody. I got to hop, but anyway, good to hear you all.
Thanks, Jim. Have a good weekend.
Just on Sunrun, they have an $80 million exposure to SVB as well.
Yeah, so based off of what Jim had said, he probably didn't hear my earlier Frankenstein of 30 and 73, but I wrote something back in December, and I quoted a piece from Megan McArdle from something she wrote in April of 09, which was obviously ill-timed given where we were at in the cycle, but I think it's applicable now in a way. Again, these things are piecemeal. They're not exactly the same. So I'm just going to read it real quick. A section that I quoted. I don't want to push the Great Depression analogy too far, but what's surprising when you go back to primary sources from 1930 is the optimism. I don't mean to imply that everyone thinks things are just swell, but while you know that they are facing the worst economic decade of the 20th century, they don't. They're expecting something more like the recession that followed World War I would argue 2008. People are cutting back, but they're still spending, particularly because companies are slashing prices to move inventory. It was the long grind of the years that followed and the catastrophe of the second banking crisis that scarred them permanently. And this shows up in the economic stats and the stock market, which did not, as we like to imagine, simply decline in a straight line. Relative to Chanos' comments, it's surprising that it's taking this long in certain ways. It's that lingering optimism, I think, that's emblematic of where we're at in this cycle, with a lot of the stuff that, again, is fairly obvious, but I think lacks historical context because of people haven't seen this kind of thing in a long time.
Well, to the point, it's about credit. Just imagine this: September of 2007, high yield credit spreads are at all-time lows, or 20-year lows, or for all intents and purposes, all-time lows in September of 2007. The reality is, as I've been harping on forever, markets do not look forward, do not discount something until it happens. Most bear markets begin going back 100 years when unemployment claims start ripping higher, not 6 months or 9 months or 12 months before. It's black and white if you looked at a chart of it. So, the reality why credit's so tight now, credit spreads, is because people think there's no landing, soft landing, which always happens between the end of a tightening cycle, which we're not at yet. Maybe we are now, but we'll see. And that beginning of rising unemployment. And that's the behavioral aspect. Again, it literally doesn't change every single cycle.
But we should also be looking at profits and default rates before we look at spreads. And default rates are extremely low still. I assume they'll double or triple over the next 2 years. But, the reality is that default rates are low. So why should credit spreads blow out yet?
Yeah, well, I agree. I'm not saying they should blow out. I agree with that. They've bounced around in the last 6 months, at the highs of the panic around the UK pension issue and China not being open and Europe having a crisis. That all went away, and that brought spreads back down to, high yield spreads down to 4.5. And the reason default rates are low, even though they're slowly starting to rise. We're looking at delinquency rates for consumers, for autos, for bankruptcies is starting to pick up. Is we're still in this inflation illusion that's keeping revenue ratios to costs, however you want to say it, margins or compensation ratios, extremely high, which either inflation has to stay high to keep that high, or inflation comes down as growth slows and the tightening cycle does what it always do and hits unit demand even further. So no, I agree with you, Bobby. That's definitely. But is that persisting? As that changes, markets will reflect it. As the facts change, the markets will change, but it won't happen 6 months ahead. So I think we're saying the same thing.
So can I ask a question? Does this pull forward? We're talking about $170 billion in uninsured deposits, right? It certainly seems like they're going to try to get them covered, but does this pull defaults forward Roku has 487 million in SVB. Roblox has 150 million. Sunrun has 80 million. Ginkgo Bioworks has 74 million. Rocket Labs has 38 million. So if the solution is time, right? Does this pull forward defaults?
I don't think so. I don't think this is going to be a credit event. I mean, that I think this is what I was saying. This is a head fake, a distraction from the stuff that Chanos was just talking about relative to the actual risk to the cycle, which the regionals are hugely exposed to, which is the commercial real estate market, and that really has not much to do directly with SVB. So to me, SVB is kind of a quixotic, emblematic of an extreme version of the duration mismatch. But and that is important, but that will become more important as credit issues emerge in commercial real estate, because that really does hit their balance sheet on the asset side.
Yeah, that's like saying over the last 12 months, the same point about employment. Like most of the jobs that have been lost have been in the tech sector. That had probably zero bearing on the Fed. And so this is also similarly idiosyncratic to Kayfabe's point. This is not the broader impact of the Fed's tightening cycle. This is the weak links and the excesses that blow up first. So I'd bucket this with more of the crypto stuff that blew up, or all the excesses from COVID that we saw that have had to see some pain first.
Yeah, I just wanted to throw out a quick comment, because again, that's Mark Cohodes and Jim Chanos that have both said that they expect a buyer maybe to show up. So again, I think people that haven't traded these kind of market environments, the most bearish thing that could turn into something very sloppy would be if there is some sort of transaction that supposedly takes the risk short term of this acute event, and we get a spike and then it reverses. Again, because people that traded 08, you might remember the TARP vote. It was the one that passed that caused the short term spike, and then that rolled over and it was bombs away. So when the market goes down on supposed good news is when you know you're in trouble.
So, Amy, one of the differences between here and 2008 is the depositors are going to get 50 cents cash on a dollar on Monday morning in the worst case. So I don't see any sort of immediate pull forward of defaults here. In 2008, by the way, I was a second-year analyst trying to keep the fixed income analytics system up at Lehman Brothers, as everybody was hitting the refresh button in their point applications or in their bond index stuff. The difference there was it was a $700 billion balance sheet. There was a bunch of commercial paper, and people were stuck in bankruptcy court. So there are some differences here. And I just don't see a systemic issue.
And I would add, while they shouldn't do it, I think the big issue is the uninsured depositors at SIVB, and it looks to me like they're going to backstop them all. They shouldn't. I agree with Mark on it. They shouldn't do it, but they're going to do it, and I think this is going to stabilize the bank stocks temporarily. And we'll go into the Tuesday CPI, and that could change things again. But I think Monday things are going to stabilize because they're going to throw everything they have at it, and so I don't think this will be systemic. I agree with Jim on that.
But I
Yeah,
would.
I actually agree with you guys. That's what I was saying earlier. Like I'm thinking of maybe getting along a few of these, like Schwab, and is looking interesting. Like I agree with you. That's why I was asking the question.
But I also think that this puts the spotlight on duration mismatch. And if you go back to prior banking situations, all of a sudden the regulators wake up and they hyper focus on something because of an event like this. And you can be sure that the marching orders are being given right now, to get your asses off your home computer and get into these banks and see what's going on here, because these duration mismatches are as plain as day and they should be showing up on the system. So, duration will become a hotter topic over the coming months.
Agreed.
Hey, Cantro, I just had a quick question going back to your jobless claims comment. I'm curious if you have data off the top of your head as far as what claims do versus the start of the S&P. Do they have to be up a certain percent year over year? And then, so that's A. B, how does that fold into how you think about the market here? Do you see the bear as starting last January, or do you think it's more kind of starting here in February?
Sure. So I guess one by one, there's no magic number with claims. I think a lot of people tried to do that last year when claims were up a certain percentage, which had been consistent with playing with numbers to try to find out what the magic level on anything is kind of a fool's game, because things are not static over time, and claims particularly is not exactly a data point that you can compare across time. Obviously, think about it. The workforce has increased dramatically in the last 50 years, though claims has been pretty much a broadly a sideways trend, if not lower today than it's ever been. So there's no magic number. I mean, ultimately, it's when claims rise, become a problem, which pushes interest rates down. And I'll touch on that in a second. And when credit becomes a problem, so it's when it's not that claims are rising, but it's the catalysts that creates. And so I don't. There's no magic number that I'm looking for, but it's rising for a persistent amount of time. Historically, so last year, the markets peaked. As I said earlier, markets reflect something right when it's in front of them, and a recession was not in front of us at all last year. And that's not why the market went down. The market went down because we had a spike in interest rates and inflation, as you all know. And though much of Wall Street may only see stocks down, recession risks up, and vice versa, that's just not the reality of financial markets. Stocks can go up and down for a lot of reasons that have nothing to do with imminent recession risks. So I think last year we had a bond bear market. Equities were the victim. And we're still in a bond bear market. Maybe the peak was a couple days ago from this, or maybe not. But ultimately, that's what's been whipping around equities. As employment, so any forward-looking indicator that leads unemployment claims or unemployment rate, any of them and when I say any, I mean things that have historical consistencies and that makes sense, such as deterioration in housing or a flatter yield curve or a tightening cycle, et cetera. They're all kind of indicating that employment deteriorates the back half of this year into the first half of next year. So that's why I think a recession starts some point in the back half of this year, not today, not yesterday. What's going to be really interesting, and again, it's all path dependent here, but the Fed never pauses because unemployment claims are rising. That's what causes them to cut historically. And again, if you look back in history, 90% of bear markets, I'm excluding 98, I'm excluding 1987, I'm excluding COVID. Those bear markets started, or I should say bull markets peaked right near the low of claims rising. Not the day, the week, but obviously it's a weekly number. It's volatile, but as claims start to move up, and again, I'll post a chart of this. You could see it. It's pretty black and white. I'm not going to mark the day. That's when bear markets start, and that usually also coincides with earnings estimates starting to get sharply hacked. What's unique today, not an environment we've had, is that ironically, employment is one of the problems today. Problems create market weakness. Problems getting resolved create market strength. Since inflation is the problem, and the inflation issue is largely around employment to this point, as employment weakens initially, we saw it on Thursday. Claims went up, stocks went up, and then obviously the focus changed. So I don't know the answer, but there's a probability greater than we've ever seen, because we've not been in this backdrop, that as the first 7,500,000 increases in claims could create another pivot rally for equities, because everyone will then say, oh, look, the Fed's definitely done. Hey, they're going to now cut rates, yada, yada, yada. I don't know how long that lasts. Again, it's path dependent when it starts, where the market is at the time it starts. But then it's going to keep going. It's not going to just stop at 300,000 or 350. It's going to keep going. And as credit reacts to that negatively, it's going to be a huge problem for equities. And so just, when rates come down and lift equities, sometimes it happens for a good reason, because inflation's coming down and credit spreads tighten, which is what happened over the winter into the early part of this year. When rates go down because of problems, whether it's a banking problem or unemployment's deteriorating, stocks go down. So I think I answered everything you had asked me. Thanks.
I can compliment a little. Yeah, I'll just add one thing to Mike's comments is, so even if you take 87, 98, 15, 16, and late 18, so those all accompanied growth rate cycle downturns, right? So that they ended up in so-called soft landings. Even 94 with the bond market, the surprise rate hikes at the time. So basically the differentiator is you get those this is why, Mike and I kind of started off at the beginning of the first space talking about leading indicators. So the differentiator is that all of those so-called soft landings, even the ones that had inverted yield curves, right, were differentiated because long leading indicators turned back up in a diffuse dispersed way, right? And with duration. That's what the NBER would call the 3 Ds. So those preceded the soft landing period. So when Powell pivoted infamously in December of 18, leading indicators had already started to turn back up. So again, causation, correlation. Did he engineer the soft landing that time? No. The way the cycle was already kind of worked out. He didn't make it worse. But, and that's why the 94, 95 cycle was so different, is because Greenspan, who was a student of Jeffrey Moore, who was the guy who started ECRI, and was the, kind of godfather of leading indicators, was a devotee at that time of leading indicators. His framework is largely leading indicator driven, and he tightened proactively when almost no one was expecting it, because of a future inflation gauge that ECRI was pointing up. And he basically did it and snuffed out the inflation cycle because of being proactive. That's pretty much the only cycle we have on record where the Fed has acted proactively and engineered, one could argue, using leading indicators, some kind of quote unquote soft landing. The rest of it kind of been, correlation as opposed to causation. Them kind of winging it and it happened to work out versus, them being the Wizard of Oz and actually, engineering it.
That's a great point, Kayfabe, because the Fed started hiking. If you look at 94, the economy was reaccelerating, and they started right when the economy was reaccelerating, quite the opposite of what we had last year. But again, the the only consistent differentiators I've found historically that separates the 12 tightening cycles since 1960, whether you go into soft landing, which happened 4 times, or a hard landing recession 8 times, was whether or not banks were tightening or easing lending standards. So throughout the entire Fed tightening cycle of 94 and 16, 17, and 18, when Powell was tightening, if you look at lending standards from the Fed's senior loan officer survey, banks were getting incrementally easier and easier. And so so I always call bullshit when people say, well, the Fed engineered a soft landing. I think it's the stacking of probabilities, which we also started talking about the beginning onset of this call. And if you get the Fed to do the same thing as commercial banks to do tighten at the same time, which we have that condition today and before every other one of the last 8 recessions, you've only compounded your probabilities of tightening and obviously of recession.
Kayfabe, ECRI's future inflation gauge right now is decelerating, but it's still very high. So, from your commentary,
Yep.
I would almost conclude you think the Fed is. I think it's pretty clear you think the Fed is over tightening. But what would you recommend in the context of the FIG being still absolutely too high?
Yeah, I think when I call this the Frankenstein of 30 and 73, that's the 73 part, which is the likelihood is that the FIG and subsequently inflation will not drop sharply until you start to get the real teeth of credit problems, of unemployment, like what most people associate with acute recession, but oftentimes don't take place until well into a recession. So again, if you go back to the 73, 74 cycle, inflation didn't peak until like 2/3 of the way through the recession. And then inflation didn't bottom, I think, until late 76, like a year and a half after the inflation was over, and you're well into recovery. So it was really the 70s that blew up Friedman and the monetarists thinking that velocity was stable. And they had, again, they didn't understand that there were discrete business and inflation cycles, that they were separate, related, obviously, but those cycles are different. So I think that's where a lot of the confusion that's going on in the current cycle is that, people don't recognize recessions are inherently disinflationary, barring some kind of currency, like Venezuela, right? If you have a currency collapse, obviously. But outside of that scenario, they're pretty much intrinsically disinflationary. It's just a question of, the metaphor I've used, it's like a python eating the rat, right? It takes a while for it to work through. And this one in particular has kind of unique characteristics because of the craziness that took place in 2020 and 2021. And the other analog with 73, 74, and again, it's not exact, but it gives you the neighborhood. Conceptually, that these things can happen, is that employment didn't roll over until it was 8 months into the recession. So, I actually disagree with Michael. I think, I think when they end up going back and backdating the recession, I think it's plausible that it'll end up getting dated somewhere between December and March. Because of what's going on in the cyclical industries, meaning that, the other stuff's coming, but some of the downturns that are starting to occur in those parts of the economy are really getting some velocity. And I think in recent weeks, you're starting to see some of this really rush forward.
Kayfabe, I have a question regarding the confusion that you're pointing to. And by the way, this is a good time to mention for a commercial that Neely has a line of designer T-shirts called "Respect the Lag," which will be coming out. But if you look at the lags of not only the tightening of the stimulus that we had, including fiscal, do you see a lot of confusion out there?
Big time. And that's part of what I started talking about last summer, was the increased risk of policy mistakes because of the reservoir of, excess savings, quote unquote, in the consumer balance sheet and the flush corporate balance sheets coming out of the pandemic. So again, that just comes back to time, and Neely's done some great work on this since you mentioned her. I've exchanged comments with her before. There seems to be a waterfall approaching this summer for the consumer, with a confluence of factors. And you're still going to have this is one of the points I've been making since this last summer, is that the distribution of all these macro data are important, meaning that people look at averages, like the average consumer balance sheet. And that's why you're starting to see cracks on the surface with, like, people under 40 auto delinquencies. I mean, people are in deep doo-doo when they're going, delinquent on their auto loans, right? So, I'm sure you remember, Bobby, back in '07 and '08, people were like, people will turn their keys in on their house, but not their car, right?
Right.
So, we're starting to see people turn their keys back in on their car. And so there's a lot of people that are having severe financial distress right now. And with the food stamp program coming off, again, Neely's written and talked about this way more. And she's the person I've learned most of this from, or heard it from. So if you want to come up, Neil, you're welcome to, obviously. But you've got multiple things rolling off: Medicaid, distributed health care from the pandemic period, student loans potentially, and then you kind of have an intersection. I've read some research on this, between a cross of decelerating nominal GDP with that excess savings, and that waterfall moment is kind of this summer. So all these things are kind of lining up. And that's also probably when you're going to start to see, employment turn with some velocity anyway. So
Kayfabe, just one last question, then I'll step down just while you're speaking. Would you agree that the Fed is unlikely to cut in response to this recession, or do you think that's just tough talk from them? And I know them not cutting, that's a discussion
yeah,
for months from now, but I'm curious what your thought is.
I think eventually they will. I think I forget who said it earlier. I think they do have. Again, the piece that I wrote that quoted the Megan McArdle article from '08, '09. I titled it "A Young
Yep.
Pal,"
No, it's awesome.
meaning that I think that. Yeah, I think that the obsession with not being Burns increases the risk of being young in 1930. So I think they're going to try to stay tight and allow, Schumpeter's Schumpeterian forces to eradicate things, as Cojones was saying should happen. And I agree with that, but that's going to be incredibly painful. And I don't think they appreciate the nonlinearity of the risks this cycle. So I think it's going to get out of control real fast, and then they will ultimately turn, but that may not be until late this year, early next year. Like, the timing of that is tough, because that's the lesson of when these cycles turn, is that you don't really, why didn't things tank at SocGen? Why didn't things tank with Bear Stearns? Why didn't Freddie and Fannie cause a crash? Right. Why was it Lehman? Well, with complex adaptive systems, it's inherently random and chaotic. Like, you don't know what the ultimate catalyst is going to be that goes that kind of phase transition into chaos. So part of the battle, I argue, is appreciating that you can't know in advance, but understanding what the risk distribution is. So I don't think the Fed doesn't think in those terms. Mainstream economists don't think that. Most of Wall Street doesn't think in those terms. That's why all their models are bad, and they always blow up during those periods. So I think it's inevitable they do. I just suspect it'll be too late. And then, I think that the interesting conversation to have with that is what it looks like coming out of this. And this goes back to, whether they unleash a different inflation dynamic, not only the Fed, but the eventual fiscal response, which, gets complicated because of presidential election coming up. And so all those dynamics, I suspect it'll take longer than most expect. And that will compound how bad this could get. Hence my 1930-73 Frankenstein framework.
Well, to your point about coming out the other side of this, I just don't know how they eradicate the inflation problem without letting the economy go through a recession on its own and restructure itself on its own without easing, because that's how inflation came back in the 70s, is in the next business cycle.
Yeah, well, again, Again, the difference in the 70s is you had a much better demographics and the velocity of money was stable. So again, this is where you've got, I call it the Lacey Hunt paradigm, which is, excess debt, demographics not great, productivity, trend growth, all those things are going the wrong direction and have been. So I think the bigger question is whether or not you get some kind of dual shift in monetary and fiscal, meaning that if the Fed cuts and they do QE, the market might go berserk for a little period of time, but I don't think that's going to change the underlying growth and inflation dynamics. I think if it's some kind of major shift in fiscal along with, and some of that's going to be built in because of just, you know, what demographics mean and how much they're going to spend on a baseline basis with Medicare and Social Security. Like, just look at the CBO projections, and those don't even build in any kind of recession in the next 6-7 years. So we could very quickly go back to $3-4 trillion deficits, and that's without them going, big on quote unquote stimulus. That would just be a severe recession. So that's what I'm more thinking of when and again, I wrote a piece last year on that about a shift in regime, and that if the pandemic normalized direct stimulus through household fiscal, basically sending stimmy checks, and it migrates into some kind of UBI thing, that to me is a regime change that could start, an inflation shift that would maybe overwhelm some of these other demographic and debt issues.
Kayfabe, I think an important thing to keep an eye on is as the federal debt grows, and let's say it goes from 35 trillion to 40 trillion in a short period of time, and if the banking system shrinks a little bit in terms of deposits shrinking, assets shrinking. I mentioned before we have 25% of U.S. banks are in securities, not lending, and I expect some of that to shrink as well. Do you think it'll be harder to conduct QE if the ratio of debt to bank deposits and reserves increases?
Yeah, I think it could, and that's part of why I think that what 2020 may end up having retrospectively kicked off is fiscal dominance over monetary, so that we're going to start, and again, they're not completely out to lunch, so they're going to recognize what happened to a degree on QE and the overuse of monetary relative to fiscal in all of this. So if they, based on a lot of reasons, but I think what you just said could be another part of the contributing factors where the pendulum would swing back towards, fiscal. And the other part of this, again, this is more so my cynical view is that, I think we're in a pendulum swinging back towards like feudal kleptocracy. The natural order historically is not what the U.S. has been, post World War II for the most part. So, as that kind of these large demographic issues globally, and it is global in the developed world, as the pie is not growing anymore, you get into like a kleptocratic regime, and how that gets carved up is a kind of a dominant thing, and I think that's an underlying thing, and the vig on them being able to do that. When I say them, kind of the powers that be, the ruling classes, the lords of the feudal system, the vig on them being able to do it goes up, and that's why sending out more kind of systemic money to the population as a way to say, hey, you're getting something out of this while we're off spending trillions in foreign wars and onshoring, subsidizing that, and like just the gravy train of the money coming out of Washington D.C. with the size of the budget. I think their ability to continue to do that is going to come with a cost, and I think a lot of that cost is going to be kind of sending out money.
All right, Daniel, if you have a comment to make, I'll give you the last word.
Thank you so much, Cantro. The only comment I wanted to make was for a layman like myself who dabbles in the market. I just wanted to say, and this is not kissing butt or anything, I really appreciate these spaces and you guys, all of you experts, taking your time out. And I know it helps us all, but for sure I've learned like a shit ton just listening in on these spaces. Thank you for having me on stage. And I appreciate all your guys' input. It's I've learned so much. Thank you.
All right, we all appreciate that. And a shit ton is an academic word. It's slightly bigger than a shitload. All right, well, everyone, it's 4:30. It's been a while. It's been a weekend. It's been a week. Have a good weekend. Have a rest of the weekend. Have a good week. And I'm sure we'll see you all again soon. Thanks.
Thanks for hosting, Cantro.